Indonesia is the world's largest producer of nickel, the second largest producer of tin, and ranks in the top 10 countries for copper. Over the last decade, but particularly over the last 6 years, the country has made significant efforts to increase natural resource protectionism measures under President Prabowo Subianto, with key policy developments this year becoming central to the outlook for these metals in opposing manners. So looking at what actions has Indonesia taken towards natural resource protectionism? Well, firstly, we've seen trade barriers increase to keep the first stage of the value chain inside the country and increase exports of value-added products. A key example of this occurred in 2020 and then 2023, when nickel ore and bauxite exports were banned respectively, while future export limitations are expected for tin and copper concentrate in the near future. Secondly, we've seen the government move to reform mining policy in order to strengthen state control and economic capture of base metals. A key example of this was in Q1 last year, when a major revision to a pre-existing mineral and coal mining law went through, known as Law No. 2 of 2025, in addition to the introduction of Government Regulation No. 8. Now, these law updates have strengthened how Indonesia governs the exploration, licensing, rights, and processing of mineral and coal resources, in addition to increasing regulations on foreign exchange export proceeds from the business, management, and/or processing of natural resources. Thirdly, policy known as hilirisasi, which translates to downstream, continues to be prioritised by requiring ore producers to refine and smelt metals domestically before they're exported. And this is not just exclusive to metals, but it covers palm oil, fisheries, oil and gas, and agriculture. And finally, over the last year, Indonesia has taken steps towards a nationwide, multi-sector, state-level enforcement crackdown on illegal mining operations, non-compliant plants and processing facilities, and unauthorised companies in forest and protected areas. Now, this action is not only unusual in its scale, but it highlights robust political backing, making it one of the more impactful resource policy shifts in recent Indonesian history. And a key example of how wide-ranging this policy is, at the time of writing, even the largest nickel mine in the world, PT Weda Bay, has not been able to avoid investigation. However, of the 45,000 hectares owned, the Energy and Mineral Resource Ministry only seized 148 hectares. Indonesia is the dominant force in the global nickel market, accounting for approximately 60% of global production and holding the world's largest nickel laterite reserves. Its continued investment in downstream processing and refining capacity has enabled the efficient conversion of lower-grade laterite ore into high-grade Class 1 nickel, strengthening its strategic influence over global supply chains and pricing dynamics. Previously, Indonesian Coordinating Ministry for Maritime Affairs outlined that nickel prices are likely to be held between two key levels, $18,000 per tonne at the high end and $15,000 per tonne at the low end. The explanation for this is that when nickel prices fall below $15,000 per tonne, Indonesian smelters are forced to cut production, while nickel trading above $18,000 per tonne negatively impacts demand from its fastest growing end use in lithium-ion batteries for electric vehicles. However, with this said, Indonesia has become a victim of its own success, with double-digit output contributing to a global glut of supply, which held the market in a surplus pattern over the last 4 years. Furthermore, the fast-tracking of Chinese and Indonesian brands on the LME have led to global stock levels hitting a peak, with nickel prices plunging to their lowest level in 2025 since 2020, hovering below $15,000 per tonne towards the end of the year. Now, given this backdrop, it is not surprising that Indonesia has stepped in, and at the start of this year, we've seen the power that Indonesia holds to move the nickel market. Indeed, while several steps have been taken over the course of 2025 to increase the country's control on nickel production and processing, including moving back to a 1-year annual mining work plan from a previous 3-year one, alongside the introduction of new mining royalties on companies last April, which increased production costs in the longer term, The most significant change has come from the announcement of the 2026 work plan, in which nickel production is set to be scaled back to 260 to 270 million tonnes from 379 million tonnes last year. Initial market estimates are pointing to global mine supply posting an annual decline of around 15%, marking its first fall since 2020 and prior to that 2014. This in turn could have a meaningful impact on the global market equilibrium, moving it towards balance. Indonesian smelters are likely to continue importing nickel ore from the second largest producing country, the Philippines, with rural locations making it challenging at times for the government to control output. Mines like PT Weda Bay, the largest nickel mine in the world, which is set to undergo a quota cut to 12 million tonnes from 42 million tonnes last year, have outlined that they will be applying for a revision. Meanwhile, eventual amounts produced can differ from the initial figures, with reassessments set to take place at the mid-year point. Furthermore, domestic producers have been granted the right to produce 25% of their original mining and smelting allowance attached to the 3-year licence in Q1. However, with all of this said, in our view, nickel prices are likely to hold up well in the short term, with rising investor interest, not just from nickel-specific fundamentals, but from the wider market move, in which we've seen a spillover in appetite for precious metals into the base metal complex. Looking to the tin market, while Indonesia does not quite have the same foothold in mine production as it does for nickel, it is the second largest producing country for tin, accounting for 22% and 20% of global mined and refined production, behind China respectively. However, where it does take the top spot is in exports, and it is in this specific area in which Indonesia has a very significant impact on trade and price performance once again. Now, a key example of this was in 2024, when tin mine supply fell to its lowest level in 20 years as a result of increased efforts to crack down on illegal mining and corruption, pushing exports into the red, down a significant 33%, while exports to China itself fell close to 50%. Where in contrast to nickel, Indonesia's tin sector is expected to see an increase in official production quotas this year. According to the Indonesian Tin Export Association, quotas are set to rise up to 60,000 tonnes from 53,000 tonnes previously. This policy shift comes alongside a number of positive supply developments. Myanmar's Manmore mine in the Wa state, the largest source of tin ore exports to China, resumed operations last August, following a 20-month suspension. In addition, Alphamine Resources' Bismi mine in the DRC has reported record output, despite experiencing an outage of just under 1 month in 2025 due to rebel activity. As a result of all of these developments, we expect global refined tin output to increase by 1.8% year-on-year, an acceleration from a modest 0.3% growth recorded last year. Nevertheless, supply growth remains insufficient to fully offset demand, and we anticipate the market will register a third consecutive annual deficit. Now, looking from a price perspective, we believe tin has likely reached its peak for the year, having recorded an all-time high of $56,816 per tonne on the 23rd of January. This marked a 40% gain since the start of the year and a 90% increase year-on-year. While the fundamental balance remains in deficit, visible inventories are relatively comfortable, with both LME and Shanghai Future Exchange stocks at their highest level for this point in the calendar year on record. Positioning data further suggests that the recent rally has triggered profit-taking. Combined net speculative positions across the LME and Shanghai Future Exchange have shifted into a net short territory, indicating a moderation in bullish sentiment. Taken together, tin is still likely to rank among the stronger performing base metals this year, supported by resilient demand profile and a supply backdrop that remains structurally tight, albeit gradually improving. However, given the market's relatively small size, price volatility is likely to persist. Moreover, tin's designation as a US critical mineral should continue to underpin strategic and investor interest, even during periods of consolidation.